Hello and welcome to our webinar. My name is Kiana and it's exactly 12 p.m. Eastern Time here in New York, and I wanted to do a quick sound check. If you could let me know if you can hear me so that we can go ahead with our webinar today. This is our first webinar from the new year, so Happy New Year for those of you who've come back. And those of you who are new as well, and hopefully the new year has been fruitful so far and you've been making money in Forex, and if not, this video is for you today, this webinar. So let's please, I can see that people are getting added to the webinar. I just wanted to make sure everybody can hear me. We have amazing people here today. We have, I'll have to go through the whole list. Amazingly, a lot of women today. That's great. So we have Maria, Naomi, Anna, Norman, Samuel, Artiful, Marcus, Aya, Ali, Mohammed, and so many more. That's great. So it seems like you can hear me okay, and let's go with the webinar. Today's webinar is about choosing the best currency pair to trade. So this could be a tricky question, because if some of you are here to get an answer as if there's only one currency pair to trade or two currency pairs to trade. No, that is not what we're going to cover today, because trading currency can be very personalized, and therefore basically choosing the best currency means knowing yourself and knowing your own schedule and knowing how you trade so that you can choose the best currency at the time frame that you trade. Also, well, obviously there are other effects and matters that can push you to choose the best currency that we're going to cover, all of them hopefully today, time permitting. So today's agenda, we're going to have an introduction for those of you who are new, and then we're going to go through Forex market common terms and an introduction, again, for those of you who are attending this webinar for the first time. And we'll have a broad technical analysis and fundamentals, because that is going to be our opening to how to choose the best, how to choose a currency pair to trade. And then we will review and go through which time frames you should trade the currency pair that you chose to trade. And finally, if we have time within our 1 hour, I would like to guide you through with how to come up with your own strategy based on your own personality, and hopefully we can have time to walk through the markets as well, and the live markets today. And today is Friday, January 23rd, and here we go. So please do get prepared to take notes. If you're using the latest Microsoft Surface, you can use that pen as well. If you're more of an old-fashioned person, please have a note ready so that you can take the most out of this webinar. So let's do the introduction for Orbex. Obviously, you're here because you're either a member of Orbex or you've heard of Orbex and you wanted to attend the webinar. And if we don't cover what you wanted to know specifically exactly today, Orbex does have a video library and education videos which are actually, in fact, presented by myself, and daily weekly update videos, and so many other trading tips from different vendors and analysis. And their aim is obviously to help you trade responsibly. So definitely browse inside Orbex's traders library to make better investing decisions. And as for myself, my name is Kiana, and I'm Persian. I am the founder of InvestDiva.com. I've been published by McGraw-Hill. The name of my book is Invest Diva's Guide to Making Money in Forex. It's for beginners who don't know anything about Forex, and you can get my book and really understand what is going on in the Forex world in a very user-friendly language. So my thing is I don't use all those technical words before I make sure you understand what they are, so that you don't feel that you don't understand what is going on. So Investiva's Guide to Making Money in Forex should have been titled Forex Trading for Really, Really Dummies or Beginners, but well, that was already taken. But our book is better. So definitely get a copy of that one. And a little bit about myself and why you should be listening to me. I was not a finance major. I went to college in Japan to study electrical engineering, and as a hobby in Japan, because a lot of women in Japan trade, I was introduced to Forex trading from my Japanese host family's mom, and that is how I started making money, and I got very excited about the opportunities and the possibilities in the Forex market, and I decided to pursue Forex trading. And that's why I came to New York, where I have been residing for the past 5 years, and I've been being recognized as one of the few women in the Forex industry in the U.S., which has been a great honor. And hopefully you can enjoy and learn something and take away something from today's webinar as well. So let's get started. For those of you who are not sure what Forex is, why you should be trading Forex and not stocks, here is the deal. Here are the answers. Forex is the largest market in the world. Forex means foreign exchange market, or FX. And the differences between the stock market and the Forex market, one of the main differences is that there are thousands and thousands of stocks in every different stock market, stock exchange. And for example, but the FX market, there are only 7 major currencies that most traders follow. So that gives us an edge in choosing the currency to trade to begin with. So if you're confused about how to choose the best currency, if you were trading stocks, that would be even more confusing. So you're halfway there. So that is why you're trading Forex. Another thing, an advantage of the Forex industry to comparing to stocks is that it never stops. It never, well, I'm not going to say crash, because we did have the crash almost in the Swiss franc, the dollar versus the Swiss franc last week, but it didn't completely crash. It did come back up. It didn't completely go out of business. A stock market, a stock, if the company doesn't do well, it can just completely crash and go bankrupt, and you can never see your money again. In the Forex market, it goes in cycles. If you come up with a good strategy, you can be sure that the market is going to stay there unless the euro decides a good heads up beforehand. Another really interesting thing about Forex is that it is the largest market in the world. Even though there are only 7 major currencies to follow, there are a lot more currencies as well. Obviously, there are 200 different countries with 200 different currencies, and New York Stock Exchange itself alone is 53 times smaller than the Forex market. So there you go. It is a huge market with huge possibilities, with high leverage, which is a double sword, and you do want to be careful in using the leverage. We have covered it before in previous webinars and our education videos, but just a mental note, be careful with your leverage when you are using it. So now that we covered what Forex is for the beginners and newcomers, let's cover how to make money in Forex, which is why I assume you are all here. And by the way, I forgot to say, in the middle of the webinar, please feel free to just ask me any questions. I'm keeping an eye on the chat box over here, and you have any questions, feel free to ask me. If you don't want to, nobody else can see your questions, so don't be embarrassed about that. If you forget about, if you want to ask your questions later on via email, definitely do that too. You can email us. I'm going to cover that. But during the webinar, definitely feel free to jump in, ask questions, or have your opinion, and we'll have a more interactive webinar. So anyway, so how to make money in Forex. That one is similar to any other charted market. You buy low and you sell high. Another beauty about the Forex market is, as I said, it does go in a cycle and you don't, as opposed to the stock market that it normally on a long run it goes all the way up. Then currency market, the currency pairs, they move in cycles. So you want to make the markets goes up, and what goes up must come down, and what goes down must come up, and what goes up must come down, and it goes on. And over the course of years, if you look at the charted markets, you can see how the markets have been cycling on and on over and over again. Let me just see which screen I'm actually sharing with you guys because I didn't check that one. Okay. All right. So let's do a quick brush up. How many of you guys are familiar with technical analysis and think that you know everything about technical analysis? All right, no, you don't know. Okay, that's great. We'll definitely cover a little bit about technical analysis. We won't go too much into it. Don't worry about it, Mark. So technical analysis, simply put, is the art of using history to predict the future. As we said, as I mentioned before, the market's going in cycles, and you want to know when that cycle is going to begin, when the cycle is going to end, when is the market going sideways, when is the market is trending. So we use the charts, the technical analysis, to do that. As opposed to technical analysis, another major factor in trading, any kind of trading, is a fundamental analysis. A fundamental analysis is basically listening to the gossip. I call it the gossip. It's basically the news. When you open up the news and you hear something, the ECB, Mario Draghi was talking yesterday and everybody went nuts. Why? Because they were trading the news, and he opened his mouth and he said something about the QE, and everybody started selling the euro even more. So some analysts, some traders solely rely on fundamentals. They do not use the charts, and they listen to the news and they decide where they want to go. Some traders are solely technical analysts, and they only use the charts and technical patterns and indicators and all that, and that is how they do their trading based on. But as for me, I mix and match. I do listen to the news, I do technical analysis, and furthermore, I also look at the market sentiment to see what other traders are doing, because this is a psychology-based market after all, and when people get panicked, they start selling, then the market gets sold, and then the markets go up, and that is what drives the market. So you want to keep an eye on all these and then come up with your own strategy to see what type of trader you are. And if you are a day trader and a short-term trader, you want to listen to the news. You have to listen to the news more often than somebody who's a long-term trader. We're going to cover that in a bit. So this example that I have over here, technical analysts make decisions based on patterns of activity of people going into each store. That is an example that I use in my education course on Diva.com, which compare a technical analyst to somebody who is trying to buy a shoe. So a fundamental analyst, when they want to buy a shoe, when she wants to buy a shoe, she asks her friends, where should I go? Which shop should I go? What price should I get my shoes? What is the price of shoes right now? So that is a fundamental analyst. She listens, she calls up to her friends, her parents, her mom, her sister, and makes a decision on what to wear. A technical analyst, she looks at the trends. She looks at fashion police probably, and she goes to stores seeing what other people are doing. And if she wants to go against the trend and she's like, okay, I have my own ideas, she will buy something that is not something that other people are buying, right? And if she wants to go with the trend, she will basically analyze what other people are doing and go with the trend. So it's a silly but understandable metaphor that we've come up with. Any questions up until here? I'm taking a look at the chat room. Everybody. Okay, so type in a Y for yes for everybody, for those who are excited about today's webinar. Why? Yes, thank you, Sarah. Thank you, Matt. Thanks. All right, so we're excited. We're going to have a great webinar. Technical analysis, we're going to continue. This is a chart. For those of you who've never seen it, this is the time axis and this is the price axis. The market's movements are printed on the chart to make it easier for you to use the history of the prices and predict the future. This is a chart of a euro dollar back in, I want to say, 2011 or 2012 when the prices were still in the 154 area. And what we do, we use the candlesticks and the closing and the open price of the market. I'm not going to get into it so much today, to identify the price ranges during each time period and basically do our technical analysis. We're not going to cover that today. We definitely are going to do it later on. So charts come in different patterns though. So the one that I showed you before was a candlestick chart. An old-fashioned chart, which can be seen here, is a line chart where the dots that you can see here are the market close prices that are connected together and shows an overall average movement of a market during each time period. This is an hourly chart. An hourly line chart only shows us the closing price. A bar chart, however, is a little bit more advanced, and therefore it shows the closing price by this small stick to the left, and it shows the open price by a small stick bar to the left, and it shows the closing price by a small stick to the right, and it shows the range as well. But as you can see, it's a little bit hard to see, and that is why a Japanese rice trader invented the candlestick chart, which we use today, which shows the range of the market a little bit more visibly because of the colors of the candlesticks, as you can see here. So charts come in different time frames, and you can use any time frame that you want and you feel like trading. You can use the 30-minute chart, you can use a 4-hour chart, and you can use the daily chart. There's so many other charts as well. There's a 1-minute chart, there is 5-minute chart, there is monthly chart, and there is yearly charts, right? So these 3 charts that you see here is the euro dollar at the same exact time, but in a different time frame. And as you can see, they are showing different things. Why? Because either in the 30-minute chart, each of these candlesticks were completed in 30 minutes. So it's a micro vision of the euro-dollar price action. But when we zoom out into a 4-hour chart, you see more price action up to probably like this is 2 or 3 days before. When you zoom out to daily chart, you see all the prices in the past month, right? So that is why, for example, on a daily chart, the market has been going up for 4 consecutive days. So on a daily chart, we actually do have an uptrend. But for the 30-minute chart, well, this one we also have an uptrend. This has been a good day, but sometimes they're actually the opposite. Sometimes we have an uptrend on a daily chart where we're having a consolidation or a downtrend in the 30-minute chart and so far and so forth. So you can choose your time frame based on how you want to trade. If you're a long-term trader, or if you want to trade only from here to here and get out of the market for the day, and that will be it. So basically it all comes down to you and what kind of a trader you are and your schedule, and if you like the rush and if you don't like the rush. And we do have tests to identify that as well. So let's get down to the real the base topic of today's webinar, which is how to select the best pair in the Forex market. So I've put together 5 strategies, or 5 methods to select the best pair. One of them is a strategy type, We have the currency correlations. We have reliance on one currency, strategy mix portfolio, tools, and indicators. Let's start with the first one, strategy type. Okay, so we're going to dive into this. So strategy type basically means, again, as I said, what type of trader you are. Are you a trend trader or are you a reversal trader? You have to find that out based on trading on demo accounts and see which one suits your personality and which one makes you feel better, because trading involves a lot of emotions. Hold on 1 second, we have a I'm sorry, we had a technical difficulty over here. Let me see if you can still hear me. Okay. All right, since we're still good. All right, so strategy type. Are you a trend trader or are you a reversal trader? If you're a trend trader is a person who gets on the market, identifies a trend, and rides on the trend, goes up with it, gets out of the market. If it's a downtrend, rides down the trend, and gets out of the market. If you're a reversal trader, you look for channels. You look for that market cycle. And then again, if you are a short-term reversal trader, you will look at a short time frame for your reversal indicators. And if you're a long-term reversal trader, you look at the longer-term time frame to look for your signals. So now, what does it have to do with the currency pair? So simply put, a trending strategy will have a different best moving and ideal pairs than a reversal strategy. So obviously, if the euro dollar is a trend, then this is a great currency pair for a trend trader, but not so good for a range or a reversal trader, right? But so basically, if you want to select the pair which has the best match to the market structure you're looking for the strategy, this means like this is the dynamic that you're looking for. And the pairs, the currency pairs, they change their status from trending to reversal to range constantly. So you can analyze the pairs to select the ones that best match your strategy if you're a trend trader or if you're a reversal trader or a range trader. If you use this method, then it's certainly possible that the pair, which is interesting in the past, if euro dollar was trending in the past but is now trending anymore, so now it is less interesting for you because you only want to trade trending currency pairs. So what I suggest is that when you open up your trading platform every morning, you decide whether you are a trend trader or a reversal trader or both, and you look for those for the markets that are trending if you're a trend trader, and you get into that, right? So now if you're a reversal trader or a range trader, if euro dollar is consolidating, then it could be a good time for a short time frame range trader to get into that market. And basically, if I show over here, you can buy here and sell here and get out of the market, and when the market is reversed, do the same again and again and again. So this is how a range trader will trade a range. And we have there are so many different ways in identifying ranges and trends that hopefully we'll cover in our upcoming webinars as well. So the next factor, the next method of selecting the best currency is we have different kind of currencies, right? We have 200 different currencies, and we have divided them into 3 groups: the majors, the minors, and the exotic currency pairs. So you also, basically, this comes down to you if you want to become a major currency trader, a minor currency trader, or exotic currency trader. So let's go into this and see what they actually mean. The majors are only 7 of them. There are 7 major currencies that pair up with the US dollar and what we call in the Diva Miss USA, and they build the major currency group. The 7 currencies are the euro, the Japanese yen, the British pound, the Swiss franc, the Aussie dollar, the Canadian dollar, and the New Zealand dollar. So each of these major currencies they trade against the US dollar. And the beauty of the major currencies is that they are the most volatile, and they have the most fundamental news about them, because most of the major news medium, they cover the major countries and their economic situation, and they are transparent to some extent. And because a lot of people trade them, the depth of the market is higher, and therefore the spreads are lower with your broker, so you have to pay less to trade the majors. I myself, I am a major currency pair trader as well, because I have become familiar with them. I know their tendencies, their patterns, and therefore I can come up with a better strategy with the pairs that show similar tendencies over and over again. The next factor, or the next group of currency pairs, are the minor or major cross-currency pairs. So this one, as you can see, we call it the party, because, as you know, currency pairs, the Forex trading, it always comes in pairs, and that is why in the previous page I showed you a woman, symbolic woman, symbolizing the US dollar, and she was dancing probably against the other currencies who are men. This is just a metaphor that we've come up with at Diva. And in the major cross currencies, they have kicked out the US dollar. And it's the major currencies versus each other without the US dollar. It is very common to trade the major cross-currency pairs, or the so-called minor currency pairs, in Europe, because they don't factor the US dollar as much, probably. It is less common in the US. I've seen less traders trading the minor currency pairs in the US, because obviously they get more news about the US dollar in the US. But with the internet, there is no shortage of information, of course, so you just have to decide what currencies really excites you and speak to you, and you feel comfortable trading them. So the major cross-currency pairs, I have grouped them into 3 groups. We have the euro crosses, which is the euro or Miss Euro against the 6 other major currencies: the Japanese yen, the New Zealand dollar, the Swiss franc, the British pound, the Canadian dollar, and the Aussie dollar. Then the other group, again, these go back and forth because, for example, euro, pound, or pound euro over here, they're crossing, but you get the idea, right? So we don't have to go more through with it. So the minor currency pairs, or the major cross-currency pairs, they are especially good to trade when the US dollar is consolidating, or there is not much movement in the US dollar, and that is when you can find some good moves in the cross currencies, and you can find some opportunities in the crosses. Next in line is the exotic pairs. So the exotic pairs, obviously we can mix and match the exotics with any other currency, but I've just taken a snapshot of some of the most famous exotic pairs. The reason why we call them exotics is because it's normally the US dollar versus the currency from an emerging economy such as Mexico, New Zealand, Mexico, South Africa, Brazil, Norway, Denmark, Sweden, China, Hong Kong, Thailand, and all that. And if you are from one of these countries, or if you have strong information about one of these countries, and if you're passionate about these countries, or if you're dating somebody who's from one of these countries, then this can be appealing to you to trade them. And I know a lot of traders who, for example, trade the Vietnamese currency, and they make a lot of money because they are familiar with the dynamics in the economy, and there are some real movements. Myself, my parents are Persian, they're from Iran, and the market movements are pretty interesting because they don't follow, they do follow the oil and the dollar, and they have interesting movements. So my parents, they trade the Iranian currency because they are very familiar with the Iranian economic decisions. So again, it comes down to you and who you are, what you feel comfortable trading, and what you have the most knowledge about. So even though trading the exotic currency pairs could be a little bit more expensive on your Forex broker or on an Orbex because of the higher spread, it could be very fruitful and very beneficial for you if you have the right information, if you are passionate enough to do the technical analysis needed to coming up with your own strategy. So factor 3 is relying on one currency, and the reason why I say that is some people just want to follow one currency. I'm not saying this is a good idea, but if you have a strong opinion only on the Japanese yen versus the US dollar, then be it. If you think that you can predict the Japanese market, and if you think that you know the Japanese market movements, then yeah, obviously that is one strategy that you can do. And but here's my thing. Everybody has heard you don't want to put all your eggs in one basket. So the only problem with this is that in case you make a mistake with your strategy or with your prediction or forecast, then you have nothing more to gain. That is why if you have a strong opinion on the Japanese yen and you don't want to even hear about any other currency, well, then we don't have a Forex trader here. But if you have a strong opinion on Japanese yen and you don't want to go overboard with other currencies, then you can trade Japanese yen versus other currencies such as euro or pound. So you can go to the major cross-currency pair groups and do that. So this was very visible last week when the euro and the Swiss franc, the Swiss franc certainly gained a lot, and it happened to myself as well. A lot of people made money, a lot of people lost money. I was balanced out. So what happened is that I actually do want to show it to you over here on my trading account. So what happened is, this is last week. This is last week in the Swiss franc, the dollar versus the Swiss franc chart, and all of a sudden it dropped all the way down to here. That created a lot of chaos, and some Forex brokers even went bankrupt, and people were shocked, and it was crazy. So I had completely forgotten that I had set an automated trading order at 1:20, I think that was. It was 1.2 because, oh, I'm sorry, it was on the euro Swiss franc. What am I looking at? Hold on one second. So what I had my position on was, let's see if we can find it over here. It's not very friendly. Definitely was here. I guess I just closed it because I didn't like what happened. Let's. Okay, we're gonna go here, and I'm just gonna show it to you over Euro Swiss franc. So this is the euro versus the Swiss franc, and the cap, the strategy, or what everybody thought is gonna happen is that the Swiss franc had the Swiss had the floor set at 120 for the euro versus the Swiss franc, and they had said in back in 2011 that they're not gonna let this cap to drop, and they're gonna always keep the euro versus Swiss franc above 120. So what I did years ago when I heard this is that I said, okay, if the Swiss say that, then probably what's going to happen is that when the market hits the 120 level, the market is going to go back up. And that's what a lot of people thought as well. So they hedged, and my position was at 120. If the market hits 120, I wanted to go bullish the market because I thought, all right, so the Swiss are not going to let the euro go below 120, so it's going to go up when it hits this level. And that's why I had a position ordered long ago that I completely forgot about it as well, to go bullish once the market hits 120. And guess what happened? They suddenly decided to change it, and the market's dropped, and it went all the way here. Fortunately, I had my stop loss right around here, so I didn't lose that much. But what really helped me was that at the same time, I had a bearish position on the euro dollar. So when euro franc dropped, and I had the bullish position in that, which caused me a loss, euro dollar also dropped, and I had a bearish position, so I was balanced out. And that's why I did not lose money. So that's why I don't recommend relying on one currency as much, while a lot of people will argue that that is something they want to do, so we cannot do anything about it. But that is my story, and I hope you identify with that as well. So factor 3 is the strategy mix in your own portfolio. What do I mean by strategy mix? If you only have one strategy, then this factor is irrelevant. But if you have multiple strategies, if you are trading multiple currencies, or if you're using different indicators, multiple indicators and multiple patterns, then it is smart to analyze whether your strategies are not over-reliant on the same or correlated currency pairs. So even though the strategies are different, there could be increased risk associated with trading the same pairs from a portfolio perspective. So we want to keep that in mind as well. But if you have only one strategy, then this one, as I said, is irrelevant. Next in line is the tools, the usage of tools and indicators. So one other way you can choose the best currency to trade, or the best moving pairs, depends on choosing the tools and indicators. The most important factor is that you gain experience with the tool and indicator you choose, but you also have to remember that no indicator or tool is 100% perfect, and it never will be in the future. So you don't want to rely, as I mentioned, that you don't want to rely on only one strategy. You also don't want to rely on only one indicator as well. But using useful tools and indicators for selecting pairs could help you by let's say you're familiar with Fibonacci and Ichimoku and trend lines and moving averages. So if you use a bunch of indicators and a bunch of technical analysis tools, that can help you identify the confluence together with spotting patterns such as chart patterns and candlestick patterns and trend patterns and reversal patterns and etc. to help you gain a bigger edge when you're trading. So the reason why I'm showing this makeup kit over here is because we use the indicators, the symbol, the metaphor that we use in Invest Diva's book is that you add the indicators on the chart is as if you add makeup on your face. So it basically accents what is going on the chart. The same way putting on makeup accents your features and helps people understand more about your features. If your eyes are already big, if you put on more makeup on it, it makes it bigger. So that's what indicators do on a chart. If the market is trending, the indicator, the Ichimoku, the trend line, the MACD shows the trend. It accents it and it shows you that trend better so that you can basically see it and not miss out on it. So using these indicators can also help you, as we said, with choosing your currency pair, because it helps you getting a better idea of what is trending, what is reversing, and you mix and match all these 5 factors and select your currency pair and you start trading. So after you select, or before actually you select your currency pair, before going through all the currency pairs, you want to know which time frame you're going through. Are you looking at the daily chart? Are you looking at the weekly chart? Are you looking at the 1-minute chart? That one depends on you. That one depends on what your schedule is like. Do you have a full-time job? Can you scalp the market? Can you be a short trader? Do you want to be a short trader at night? Are you a night owl? Can you stay awake all night and keep trading and pushing the buttons all the time? Or for example, I have students who tell me, all right, I think I'm not a short-term trader, but when I trade overnight and I place a trade at night, I cannot fall asleep because I'm so excited and I'm so nervous what's going to happen during that time. So then you probably want to start trading in the morning in a longer time frame and get out of the market by the end of the night. And if even that doesn't work out for you, you can get into the market at the beginning of the week and get out of the market at the end of the week, or even be in the market for a month or something using a macro chart. So if you perform better under pressure, then you want to go through your currency pairs in a shorter time frame and then use all the 5 factors that we talked about and select the best currency pair, right? If you're a long-term trader, if you have other stuff, if you have a baby, if you don't have time to be stuck to the computer all the time, then you want to choose the daily chart or the monthly chart and then use the 5 factors to select the best currency pair, right? So the next, we've covered this a little bit right now, but how to come up with your own strategy. As I said before, it's always best to mix and match different factors. I haven't put fundamental analysis over here, but it should have been here. But only even with technical analysis. You see, these normally point to the same thing after all, unless the market is completely indecisive. So if you look at the market, if you are going through different currency pairs and you don't know which currency pair you want to choose, you can add a Fibonacci, you can add an Ichimoku and an RSI, and see what they're telling you. Choose your currency pair, and then use at least 3 indicators or chart patterns that backs up what you originally or initially thought the market is going to do. So let's say you look at the chart, you look at the euro-dollar chart, you feel it's going to reverse, you add the Fibonacci, it shows you that it's going to reverse. You look at you analyze the candlestick patterns, the reversal patterns, you find 2 or 3 patterns that are indicating the market is going to reverse. That is a good indication that the chances are the market is going to reverse. But if you only look at the RSI and say, okay, the RSI is on the oversold zone, so the market is going to reverse and go back up, that is never ever recommended, because the RSI by itself can never be perfect. So coming up with your strategy, there are thousands, not thousands, but tens and hundreds of indicators and chart patterns. So the best thing you can do for yourself is to educate yourself in at least 5 or 6 major indicators. And there is no better indicator than the other. Some people like the Ichimoku cloud better because they are more visual. Some people like the MACD. But at the end of the day, they're all moving averages and they indicate the same thing. Some people like the Fibonacci. Some people like the Elliott waves. It doesn't matter. At the end of the day, it says that the market goes up this length and it comes down and it goes back up. That is both the same. So if you like Fibonacci over Elliott waves, just pick Fibonacci or either one. And again, as I said at the beginning of this webinar, it really all comes down to you and what your background is and what you feel more comfortable, because you don't want to just risk not knowing and using an indicator or a strategy or a pattern that you're not 100% comfortable with. Let's take a look if there are any questions over here. I kind of closed the chat box. Okay, we're good. I'm going to give some more time for a question before we jump into the live market through. But in the meantime, let's just brush up a little bit on Fibonacci, because I've been talking about it over and over again today. So let's say you are browsing through different currency pairs on your chart, and you've decided that you want to trade on the 4-hour chart, and you identify this downtrend, and you have decided that you are a reversal trader, right? So the idea behind Fibonacci retracement is that when the market is trending down and you see a reversal signal, as we can see over here, the market was trending down and we have a bullish engulfing over here, chances are that the market is going to go up to one of the retracement levels, the 23%, the 38%, or the 50%, and then it's going to go back down. So a reversal trader can take advantage of this in 2 ways. The first one is to get into a bullish position over here and get out of the market at one of the retracement levels. Which retracement level, or even 61, which retracement level? That depends on the other indications and the other indicators. That depends on the fundamental news. How high will the pair go within this time frame? Then what you do is you wait and you sell it and you get back at the market. So a different strategy, though, is waiting for the market to go back up to one of the retracement levels and then get into the market. So if you were not sure the market, which retracement level the market is going to go up to, you could have waited. You could have waited for the market to touch one of these retracement levels and then go back down. So the different way, or you can do both, right? So what you can do over here is, okay, you see the market touched the 50% and it went back down, so you get into the market probably around here and you wait for the market to go down and make a bunch of pips. Oh, so the market over here went all the way down, and even though you got out of the market over here, it went even further down. But then again, that depends on your own strategy. obviously want to be safe than sorry. So as we always say, don't be greedy and don't choose a very extended take profit limits because you never know what the market is going to do. So if you think that the Fibonacci is working and other indicators are telling that the market is going to go down, you want to get out of the market here and be safe. If the market trends, if it continues, that is time for a trend trader to get back on a downtrend and make money over there. So what I want to also tell you over here, for a trend trader who has been bearish in the pound-dollar market before, you can also use Fibonacci for not getting out of the market. So some people, let's say you were in a bearish position around here, and you notice that the market is going to go up. So if you use Fibonacci, you would have known the market is probably not going to go up above the 61%. So you would readjust your stop limit orders or your support and resistance levels and stay in the market until when the market is going to go down and reverse and continue on its way. So that is why that is one of the reasons why I always like Fibonacci. Elliott wave is the same. It's basically identifying all the waves that go in the same direction and not getting panicked when the market changes direction a little bit and staying in that trend. So these are two ways that a trend trader or a reversal trader can select and trade their currency pair. So the next thing that we talked about today, and I just want to touch up on one last indicator that you can mix and match with in your portfolio. This is just only my case and what I normally use. You obviously can use other indicators and other technical tools, but then again with Ichimoku, you can mix and match, right? So the idea behind Ichimoku in a downtrend is that that's the cloud, the Ichimoku cloud that we have covered actually before in our webinars. This shows this can be treated as a resistance or a support level. On a downtrend, you can use the cloud as a resistance level. When the markets get inside the Ichimoku cloud, that means a consolidation, a great opportunity for a reversal trader to get into the market. When the market is below the Ichimoku cloud, it's a great opportunity for a trend trader to get into the market because that indicates the market is probably going to continue down, and vice versa. When the market is trending up, normally it's above the Ichimoku cloud, and you can use the Ichimoku cloud as a support level. Great opportunity for a trend trader. When the market gets inside the cloud, it could be an indication of a consolidation or reversal. That can be a great opportunity for a reversal trader. So know yourself and know your indications and choose your currency responsibly. Again, a little bit more brush up. We've covered this before, but just for those of you who've been new here, the Ichimoku cloud, these are all a bunch of moving averages. This is the delayed moving average. This line that we showed before is the Tenkan line or the turn moving average, which is the fast line. The Kijun line is the slower moving average, and the Kumo is the area between two other moving averages that average the 26 candle periods before and 9 periods before. So the buy signals, as I mentioned before, is that when the candles are above the cloud, or when the Chico span, this one, I'm going to show you again, crosses above the cloud, or when the Tenkan line crosses above the Kijun line. The sell signals are when the candles are below the cloud, the Chico span crosses below the cloud, or the Tenkan line crosses below the Kijun line. Let's go back there and take a look. So here is in the downtrend, the candles are below the cloud. The Kijun line has crossed below the Tenkan line, and we don't have any indication from the delayed one, so that is not a great indication, so you can use either or. Likewise here, the Kijun line has crossed above the Tenkan line, and the candlesticks are above the Ichimoku cloud, so that is why it's a great indication the market is going to continue up. I am going to give you some time. We have 5 minutes to go. If you have any questions to cover, and then we are going to have a live market walkthrough to select the best currency pair to trade today. So one thing that I didn't mention is that if you absolutely don't like one currency pair, if you don't like the British pound for some reason because it reminds you of bad memories, don't trade it. If you absolutely dislike the Swiss franc, don't trade it, because trading, as I said, is emotional, and you don't want to get overly emotional over something that you hate and you're just trading it out of despite, and then you get into the market with a negative energy and negative psychology, and that is going to ruin your trades basically. So having a track record on how a particular pair moves in conjunction with the strategy will help you identify the more profitable pairs. Sorry, I think I just clicked on the not showing the. So lastly, we have 3 minutes to go. I just wanted to show how I select the currency pair in the mornings. As you can see, I have a bunch of currency pairs with different time frames on my portfolio. And every morning, I just click on one after another and see what is going on, just like with a quick look, what is going on in each and every one of them. Different time frames. And also I look at my own schedule, right? If I cannot trade on an hourly basis that day, I won't do it. So let's say, look at this cycle, the British pound versus the US dollar. It's going down. I've already got out of that market. But there is a possibility that the British pound is going to go even further back down from here to here, right? So I would keep this one in mind as for a bearish position. I will quickly scan through other currency pairs. So for example, dollar yen over here, I wouldn't get into that market because I am not a range trader. As you can see, the dollar yen over here is consolidating. It's inside the Ichimoku cloud and it's teasing the 23% Fibonacci level. For a range trader, a short-term range trader, if I wanted to do that, I would change the time frame to, let's say, 1 hour or something like that, and trade this range over here. Because it's consolidating, you get into the market here, you get out, you get into the market here, and you get out, and you basically bounce up and down because you know that the market is consolidating, right? So for me, that would not have been an option for today because I had this webinar, so I couldn't do range trading. I would have probably gone with the pound dollar. But also keep in mind that today is Friday and the volatility really slows down in about 2 hours, in about an hour actually, at 2 p.m. Eastern Time, 2 hours before the New York Stock Exchange closes. And you also don't want to get into the market exactly on Friday because sometimes on Monday or Sunday night in New York, the market suddenly comes up with a sudden news that makes a gap in the Forex market. So if you do get into the market on a Friday, make sure you adjust your limits and stops properly. And to avoid a shock, on a Monday morning. So that is it for today. We didn't have questions. If you do have questions that you think of, unfortunately we don't have any more time left, please do email. Let me give you the email address over here. Email info@orbex.com, or you can email myself, Kiana@investdiva.com, and we will be more than happy to help you with your questions. Thank you very much for listening, and I'll see you in the next webinar.